We're going to go over all of our email templates and what they mean, how you're going to use them. And we're going to share screen 2. Okay, so email templates are going to go into our Gmail. You're not going to have all of these templates, but you're going to have some of them. So go into compose an email. Hopefully your email pops up big like that. Glorious. I'm going to delete my footer just so we can see the templates. So the first template is PQ info. You have that one, right? You click on that one and all this stuff's going to come up. The reason I have these templates is this is when people email me about deals. It's always a real estate deal and they want to know, can you do this loan? Well, the first thing that I need to get is all the info that I need from them. And this, and a lot of times I'll say, well, this is general pricing, but this is the info I need to get you exactly what I can do. And so here's our products, our main products. And in this email, I say here's some initial terms on our products, general pricing, and what I need from you. Exceptions are available because we can always make exceptions because it's our money. If we like the deal, let's do it. The first one is a bridge runway to sell product, and 9.95 is the interest rate, interest only. And that means that if it's a $1 million loan, then 9.95 is the interest for the yearly interest. So let's say $1 million times 0.0995, that's $99,500 for the year. And their payment is just every month what that is. So that yearly 99,500 divided by 12, their monthly payment would be $8,291.67, just because that's 12, one part of 12. They're paid every month, and that's the yearly. Does that make sense? And 1 point, yep, is 1% of the loan. So that 1 point would be 10 grand. So that's really cheap hard money right there. It's called our runway to sell because it's a 3 to 6 month note, and the note is it's the promissory note, meaning you're going to promise to pay. The note is all the details of their promise to pay and our criteria for how we give them all in the promissory note. And a 3 to 6 month note means you have to pay us back in 3 to 6 months. That's really short. 12-month term is usually a short-term loan, considered bridge, because it's like, I want to get from here to there for you, and you already have an exit in 12 months. It's just a short bridge loan. It's mostly what we do. 3 to 6 months is even shorter. That's like crazy short. So that's why the rate is lower, because most of our rates are closer to 12%. This product is because the property needs to be nice, staged, and listed for sale. That's the main part about this particular product. Runway to sale is just for basically people who have a property they've renovated, maybe just built, and they're trying to sell it. They put a bunch of money in and they want their money out while they wait to sell. So we'll give them this product. We'll go LTV is loan to value. We'll go up to 80% of the loan to value. So if the property is worth $1 million, up to 80% would be 800,000. Okay. And then a little less if they want cash out. So the difference between up to 80% loan to value and 70% if it's cash out is if we're just paying off debt that they have, or maybe they have a current loan that they use to build the property, and they have some other debt that they need to pay off, we'll go up to 80%. But if we're actually giving them cash, they have cash and they can go start another project or do whatever they want. It's actual cash. We won't give them as much. And the reason we won't do as much is because if you give people cash, it's like, to them, it's more of an incentive to not pay us back and just walk. And now it's like they got the cash. Oh, it's like, well, it's just like selling. And who doesn't want to get it? And then we don't want to lend to take a property. We want to lend so people pay us back. And so if we're giving them cash, it's usually a little bit less. We want at least a 640 credit score, and we want the points could be moved as an exit fee. So usually when you get a loan and you have points, the lender will charge points. The broker who brought the deal to us, they'll also charge points, and then the borrower has to pay that. There's enough room in the loan, we can pay it all through the loan. Sometimes we got to pay out of pocket to get their loan. But we could sometimes do it as an exit fee. What that means is, well, it's not closing costs, because closing costs has to do with funding and closing a loan. It would be when they pay off our loan. Remember, this is a 3 to 6 month loan, or maybe even a 12-month loan on other products, and we can have it as a part of the payoff of the loan, but they would have to pay it off when they pay us off. And if it comes to the point where it's time for the loan to mature, which is just the end of whatever the note length is, the loan comes to maturity, then they need to pay us off. And if they don't pay us off, then we foreclose on the property and we take it back. And then it goes to auction if they don't make us current. And at auction, either somebody pays for the property that's more than our debt, and then we get paid off, and then it goes back to their owner, right? Or sometimes at auction, it doesn't even get enough to pay our debt, and then that's the we take the property back. And then we would probably look at it and see the needs fix it up, and we list it for sale. So, very rare that would ever happen for our deals, because usually if we lend on a property, it's because it's going to stay. And so anybody in the right mind wouldn't let us take it back. It's happened, but they're dodos when they let it happen. They shouldn't have done it. Because when we take it back, we always make more money by taking it back than we would by them just paying our loan. Yeah. Because we're not going to land on a bad property. Anyway, so points can be moved as an exit fee instead of upfront. When we do move it to an exit fee, it's always at least 150%. So 1 point in the front would always be at least 1.5 points in the back. We usually do just California, but we consider high-end or resort area residential homes, residential, in major metro areas. So we'll go all over the country. In fact, I have a map of the country that shows where we do land and where we don't land. This is in your email. I'll show you the different folders in your email. But mostly we're just California. Let's see here.
My thing doesn't look it's just a little bit.
Okay, I'll send you an update. Send you this to update. Let's see, loans and Jcap. I change this all the time. That's why it's like that. And so I'm going to show you also how to update your template. So what you're going to do is you're going to open my email. And then you get the template, and then you open the email and mark edit the subject in the top part of the email. You see what that is?
Isn't it on Outlook?
I sent it to your loans at Gmail. Loans at jcap.net. See it?
Yes.
And then make sure that the subject doesn't say forward or regard. You want to make sure. So what you do is mark so it doesn't indent the whole thing and change the formatting. You can go to forward. Your reply is going to indent the whole thing. But if you forward it, it keeps all the same. So then you want to so with all these extra stuff, and you want to go up to here and edit the subject line. You want to take out that forward. And then this is the new one. You want to take out the footer. Doesn't, okay, that doesn't show. So then you go to templates again. And then go to templates and then go to the bottom and say save draft. And then you want to save as that one. Yep, and then save, and then that's going to replace that. So now, once you replace it, you've made sure that the subject is the way you want it. And the reason why you want to edit out the if it says like forward or something right here is because now every time you open this template, this is going to be in your subject line. And sometimes that's helpful. It's because you don't have to rewrite the subject line. Anyway, so the bridge runway to sell is really cheap. It needs some certain things, like we're probably only going to do this product in California, $2 million loan max. Most of what we do is the second one, the bridge first, 11.75% up to 12.5. Most of our deals are like around 12%. We're going to be 1.5 points plus, and then our really small deal, we're probably going to be a minimum of $4,000, maybe $3,600 as a minimum fee. And like if we do a tiny deal at $30,000, 1.5 points is like $450. We're not going to do a deal for $450. So we'll let someone have a small loan, but at a certain point, if the fee is less, if 1.5 points or 2 points is less than $4,000, it's going to be a minimum of $4,000. Maybe 3,600, but that's what that means. And then 30,000 to 3.5 million is our norm. 3.5 million to 5 million, we can deal with an exception if we really like the property. Bridge second, the rate's higher and the points are higher because as a second position, it is more risky. So the positions are, if you have a first position trust deed, which is what we consider a mortgage, that means that if the property is foreclosed on, you get paid first. Right, so second position is a junior lien, meaning that if you have $1 million loan on $1 million property, and then someone has a $200,000 second lien on that same property, it goes to foreclosure and somebody buys it for $1 million, that $1 million first loan gets paid off, but all that money is used to pay off whatever debt there was. And once it gets to the second lien, if there's money left, they get paid off. If there's no money left, you just lose it. They get nothing. So it's just riskier to be a second trustee if they don't pay as promised. So because of that, we charge more. Seconds, higher rate and a little bit more points. We're going to do $500,000 max second, maybe $750,000, maybe up to $1 million if we really like the house. All of our payments are interest only. We have no prepayment penalty. So prepayment means that a lot of times the lender will say, I'm going to give you a loan, but you have to keep it at least for 6 months because lenders make money off the interest. We have no prepayment because we charge points and we have higher interest and we charge fees on top of that as well. And so that means we make money by doing a loan. And if they paid us off the next day, we still made money. And since we're not selling our debt, usually we're keeping all the debt, meaning in the conventional world, if you buy a house, you want to live in it, you want a 30-year fix. Fannie Mae and Freddie Mac are two big private institutions that guarantee the loan. And so these big banks will actually have them guarantee this loan, and all the lenders that are giving you the money, the Bank of America, they're actually selling that debt. Basically, yeah. And so which we're private money, we raise money just from wealthy people that we know, and we lend the money, and that's us. We don't sell to anybody else. And so when we can lend the money and they pay us off, all that fee we get to keep, and it gives us more money to lend again. We have a limited amount. I mean, the banks can lend trillions and trillions. We can maybe lend 40 million at a time. So we'll run out of money really fast, actually, if we don't turn it a lot. That's what no prepayment means. If they pay it off the next day, we don't charge them a fee paying it off too early, which the big banks will do. It's usually a 12-month note. Points can be structured as exit fee. Barry went over that. On a refi, we're usually at 65% loan to value is our max. That's LTV and CLTV. So LTV is loan to value, CLTV is combined loan to value. So when you have a second, and that second always has a first, makes it a second. So that first, a $500,000 first on $1 million home is 50% loan to value. But when I add a $250,000 second behind that $500,000 first, that's a total of 750 grand in loans. That's 75% CLTV. That's just the combined loans divided by the value. That's how you get to 75%. That makes sense?
Yes.
So smart. We're going to go a higher loan to value on a purchase. Now, the reason of that is we're kind of guessing on the value on a refi, because the real true value of a property is a willing buyer and a willing seller. And that price is the true value. That's the only real estimation of value, willing buyer, willing seller. But when you have a property that someone owns and we don't have a willing buyer because they don't want to sell, they just want more money. What we do is we look at homes around it that have sold recently, and yeah, all the comps, and it has to be close by. We like it within a mile. It has to be recent. We like it within 4 months, and it has to be similar. So similar square footage, similar room count and bathroom count, and then that just gives us a guess. So we have appraisers that we'll hire to give us their value, their opinion of value. But all the while, it's still just a guess because we don't have a willing buyer. And so we'll do lower loan to value because we're kind of guessing on value. But on purchase, well, value is pretty set. We actually have a loan buyer and a seller, as long as they're not in cahoots, like they know each other and trying to game the system, which does happen. We'll lend 70, maybe 75% loan to value, higher on purchase because we're more clear on what that value is. Now, rehab loans is a different animal. A rehab loan or a construction loan is when someone has a property and they want to add value to it. And so they say, hey, I'm buying this property for $500,000 and I want to put $100,000 into it. And if I do, it's going to be worth $1 million. So we have these different categories. But that $100,000, we're going to give them a purchase loan, maybe up to 70%. So it says down here, purchase loan upfront is up to 70%. That could be maybe higher, but it's usually about 70, meaning that when they buy the property, we're going to give them a 70% purchase loan. So 70% of 500,000, what is that? Yeah, so 500, yeah, so that's 350 grand. A purchase loan, but we're also going to give them a loan for the renovation property. So we'll give them $100,000 to renovate it, as in the end it's going to be worth $1 million. That's great, but we're not going to give them cash for that. What we do is we give them the money as a construction holdback. So the money is held in an escrow, and how they get the money is they give us a budget. They say, okay, $100,000, great. What I need is an itemized budget called scope of work. So basically list each thing that they're going to do, and then what the description of the thing, and then what that thing's going to cost. So it's like, demolition of the kitchen, $500. Replace counters, $1,000. Replace flooring, $5,000. And it just kind of goes through each of the items, and then how they get money from us, from the construction holdback, is they pay out of pocket their contractor, whoever they've hired, to do at least one of the budget items. They finish one of the budget items, and once they pay them, and we have proof that the work is done, we go out, we send an inspector to say, is the work done? Yes, they tell us. And then we pay them back the money that they spent. So because of that, we need them to have reserves, working capital. So if they want to do a construction loan and they have just enough for the down payment, but they have zero money left over, we probably wouldn't give them a loan because they have no working capital. Or probably not going to give them cash. The reason is if I give them cash and not a construction holdback on a house that's going to be broken, because the first step on all these things is usually demolition, right? We want to tear out the stuff that looks bad. If they stop right in the middle of it and we have to foreclose, now we're taking back a house that's totally broke. It's only going to be worth $1 million when it's finished. So how do we assure that $100,000 they're going to use on the house and not buy a boat or something or another project or something besides the project that we want them to be spending? Well, the way that we assure it is the construction holdback. They're going to spend the money out of pocket to do at least a portion of the whole budget, which is just one line in the budget. And then once we have proof that it's done, then we reimburse them. They get that money back, and we can use it for the next line item in the budget. Make sense?
Yes.
So that is a classic way to do construction financing, and that's what we do. So the rate 11.75 is 12.5. We're going to do 1.5 points. And then we could do 1.5 to 2 points. This isn't set. This is general pricing. We're going to do up to 75% of the cost. And what that means is cost is the purchase price or the value if they've owned the property for a long time and buying it, plus all the costs, plus the budget to finish. So let's say that they're buying a house for $500,000. They already spent, for some reason, architectural design drawings. Sometimes there's weird scenarios where that cost was already spent and the budget to finish it is $100,000. So they spent $5,000 on the drawings. They're going to buy it for $500. They're going to spend $100,000 on the budget. What I would do, the cost for that project is all those added together. So that's 500 plus 100 plus 5. So that's $605,000 total cost. If I were to do 75% of costs, it would be 605,000 times 75%. And let's see, 605 times 75. So that would be a max loan that I would give them, probably a 450. And then a portion of that goes to the purchase, but whatever's left over, they need to come out of pocket because that $100,000 construction holdback has to be whole. So I need that whole 100,000. So whatever we're not willing to lend, they have to come out of pocket. And so that's how that works out. We're going to do a max of 75% and a secondary limiter no greater than 65% of the ARV. So ARV means after repair value. So remember, in this particular case, the ARV is going to be $1 million. And so 65% of $1 million is 650 grand. Well, if the max loan to cost, the LTC is 450, that's way less. Yeah, that's great. In fact, in that scenario, we might even go up to 80% of cost. Maybe I've done deals where we went to 90% because the after repair value is so much greater. Basically, they found a really good deal. But if the after repair value was going to be 650, let's say, 650 times 65%, that's 422. So now my 450 LTC is more than 65% of the ARV. And so what we would do is we would limit it to, if this ARV is less, that's going to be our maximum. So whatever is less, the max LTC, which is loan to cost, or the max loan to cost, the max after repair value. And the reason is, if their estimation of after repair value is too high, we're going to get an appraisal. We're going to do a review called a feasibility study on their budget, and we're going to get experts to tell us what the values are. And if they're off, we're going to know. And we're just going to give them the lesser of the two. We want to be conservative. That makes sense?
Yes.
So we're going to the purchase loan up to 70. So that purchase loan is that first money, that first dispersion to buy the place. And then this other stuff is how much we're going to be able to set up as the construction pullback. And then the payments again are going to be interest only. There's going to be no prepayment penalty again. And these are going to be 12 to 18 months. If you do a big project anywhere in California, it's hard to do a project in this 12 months just because getting plans and permits approved, especially in Southern California, it just takes a long time. 12 to 18 months. So that's the general stuff that we'll do. Nothing is set in stone. Sometimes we'll go higher leverages. Leverage just means how much money we're going to give as a percentage of the property. And leverage is a general word for all that we just talked about. And so sometimes we do higher leverage because we like it a lot. If it's here in Newport Beach, we're probably gonna do like super high leverage because it's right here, grade market. If they mess it up, we'll just take it back and finish it.
Yeah.
If it's a deal in Pennsylvania, we're gonna be real conservative. In fact, we're gonna make sure one of our investors is gonna buy it. So we want to know what our investors' opinion is, and what they're gonna do is what we're gonna do because we don't repeat it. Because if the sponsor, which is the person in charge, on the hook if the deal looks bad, just kind of like the borrower, the one who's guaranteeing them. If that person messes it up, the deal messes up. And so we're relying on a stranger basically. So these deals that are renovation, they have a higher chance of getting messed up. So if they're out of the area, we usually sell those. So I'll send this email and I'll say, does that work? And usually the broker's like, oh, I don't know. So they don't. A lot of times brokers don't know these deals. You might know more about renovation deals now than brokerage. A lot of these brokers. So congratulations, you're getting really smart. Anyway, you'll tell them these things, they won't know what it means, and so then I'll start asking questions. So below here are the different sets of questions that I'll ask. So this first one is the bridge loan. There's no renovation needed. They just need a short-term loan. They just need either paying off debt or cash out to do something, a first or a second. And I just need all this info. I need to know the full address. People will be like, it's in Orange County. Okay, great. Where? It's in the major metro of Texas. Okay, great. Where? It's in 92727. Okay, great. That's a zip code. I want the full address because we look it up. I look it up online and we review it. So what's the type of property? What's the purchase price? What's the as-is value? What's the current loans on the property? What's the loan you need? If it's cash out, what do you use it for? This is important to us because if they're using it to renovate the house, we're like, oh, really? You're renovating the house? Well, now that sounds like a renovation loan. Oh, you're buying another property. Oh, great. Maybe we can be the purchase loan for another property. So it opens up more doors on what we're going to do if I know what they're going to do with it. And then especially if it's an owner-occupied house, if it's business purpose versus consumer purpose, that changes the criteria of what I need to ask for. So what do they do with the money? What's their credit score? OO is owner-occupied. NOO is non-owner occupied. Exit, how will they pay us off? So once again, we're short-term bridge, so I want to know how they're going to pay us off. And the more clear that is, the more likely we're going to give them a loan. If it's like super, super clear, like for example, it's a great property, it's listed right now, and it's listed for a good price. Like, okay, well that thing's gonna sell. We might even buy that property. So we're likely to give them a loan with a high leverage. If it's not a clear exit, like we don't know how these guys are going to refi, they say they don't want to sell. Nothing looks really good, but the property is okay. We'll probably lend on it. We might still do it. How will they come up with the monthly payments? So every month they're going to have an interest-only payment. I want to know how they're going to pay that. So we might not income qualify them, but I still like, okay, well, it's not a qualification for the loan, but I still want to know how you're going to pay it. And if we really like the property and there's enough room, like they don't need our max leverage for the loan, we can sometimes put all the payments for the whole year in the loan if there's room. So that solves that one. I ask any tax liens or judgments, and the reason is you remember the first position, second position, the second position is riskier because they get paid. So if a person has tax liens or judgments, these often take a priority of even a first position loan. Yeah. And so if they have an IRS tax lien, the IRS tax lien is going to take their money before the first position loan's paid. So I want to know what they are, and we're going to pay them off. We're not going to do a loan with them outstanding because we get foreclosed on, and there's not enough money. They have a $500,000 tax lien. the government takes their money first. Yeah. So I want to know what those are. And then I always want to know, do you own other properties that we can cross to make the deal work? So let's say that they have a property and there's not enough value, not a clear exit. We're probably not going to do the deal. Well, if they have this other property that we like, and they're like, oh, well, that's a separate one and whatever the case. If they're willing for us to cross it, what that means is we'll have one loan and I can put a lien, just like a first position or second position lien on a house. I can put a lien on multiple homes for that one loan. And so they need $1 million. I'm like, I'll give you 500,000 for that house. Do you have any other houses? They're like, oh yeah, well we have this. We have our primary residence, and it's worth $2 million, and you also have a $500,000 loan. I'm like, okay, well why don't we cross it? So that one loan maybe is the first position on the house that they gave us, and then a second position on their primary residence, and then we feel good about them having more stake, and then we have more access. Theoretically, we can perform both properties if they don't pay us, which again, we don't want to do that, but as backup, we always have worst case scenario. Yeah.
How would that work if you're in the second position on the primary residential unit?
So if we're in secondary position to foreclose, we usually have to pay off or keep paying first. So because of that, we won't go second position on a loan behind a loan bigger than 1.5 million. Because in order to foreclose, we'd have to be willing to pay off that first, be able to make sure that we are paid. What we don't want to do is go to foreclosure, and for some reason it didn't sell for enough. There wasn't enough. We pushed it into foreclosure, but we ended up canceling our own debt because there wasn't enough to get to us. Right? So what we do if we did push it into foreclosure, we would have to pay off that first. So now we're in first position, and then we finish foreclosure. And it ends up being new debt. So that's how that works. So if it has, let's say it's a $15 million house, it's got $3 million first, we probably wouldn't do a second because we'd have to be willing to pay off that $3 million first to be able to make sure that we don't get snuffed out of the deal. So that's why we ask, do you own any other properties? So that's a bridge. Now, when it comes to rehab, I want to ask a lot of the same questions. I have these all as a template because I only ask them one set of questions. So depending on what they want, I'll delete the rest. So let's say they want a rehab deal. I'm not even going to ask them these questions. That's going to be deleted. I'm going to go right to the rehab questions. So these are a lot of the same questions, but I'm also going to ask, what's the budget? So that's not in the bridge. And I'm also going to ask, is this a mid-construction deal? Did you start construction and then run out of money right in the middle of the project? We'll do those kind of deals sometimes. And if that's the case, I want to know what amount of work has been finished to date. That's part of the cost. What's been finished to date at the bridge? What's the budget that needs to complete it from this point on? What's the value of the property? So there's all the costs. What's the actual repair value? What's the cash reserves? I want to know that they have reserves in case things go bad, and they have working capital. That's why I ask them, how much cash do you have? Experience, how many like projects completed in their name in the last 3 years? And so if they're doing a ground up construction, which means it's dirt, or maybe it's got a foundation and they're going to build it up from the ground. That's ground up. Rehab even is the budget. A light rehab is the budget to complete the project is the same or less than the current value. $500,000 value property has a $500,000 budget. That's the max of a light rehab. Once it goes heavy rehab, the budget is more than the current value. So we got a $500,000 place. We're going to put $1 million into it. That's a heavy rehab. But it's still rehab, which are easier to do. To be a rehab, I think you just need to keep 3 of the original main supporting walls. So you can break the thing all the way down to.
Someone in my neighborhood just finished doing that, and they only kept 4 up.
Yeah.
4 supporting walls.
So they do that so that you can keep it as a rehab, because the rehab details. So I can do a rehab, even a heavy rehab with zero experience, which is this particular question. And I want to know how many like projects. So maybe they've done light rehabs, which would probably count. But even if they've done zero, I can still get them some money. It's going to be a little less leverage. They're going to come out of pocket a little more. But I can get them it. But if it's a ground up construction, I need actual ground up constructions done. So like projects to be able to get them another ground up construction loan. We don't do many ground up constructions just because they're a big hassle. But that's project. So many like projects completed in their name. So a lot of times people will be a contractor and be working for other people. They've done a ton of projects, but they didn't complete them. They weren't their projects. They were just doing the work. That doesn't count as experience. We need your deal, because there's a different kind of responsibility when it's your deal. Because it can go totally sideways and go over budget or all kinds of stuff that you don't care about because you're getting paid as you work as a contractor. But we want someone that ran their own project. It was theirs. 3 of them currently, or at least how many in the last 3 years? We need at least 2 completed as a ground up. You don't need to remember this, but just the criteria is different. And then I want to know how many of those in the last 3 years. And then also how many before ever. That's nice to know, but it's going to be important to qualify them. Credit score, is this owner occupied or not owner occupied? How are you going to pay us off? How are you going to make the monthly payment? Do you have any tax liens? Do you have any other properties? So all those are the same. So DSCR, I've never actually done one DSCR. What a DSCR is it's debt service credit ratio. I don't know what the stands for, but it's basically the income from the property, the rental income is enough to cover all the expenses of the property. Cash flow, does it cash flow is another way to put it. If the cash flow is at least breaking even, then that's a DSCR 1. If it cash flowed enough to be double the expenses, then that's a cash flow 2, a DSCR 2. And so for these DSCRs, we want at least a cash flow property, a number, DSCR number 1 or greater. And then we would just need this information. And then these loans are actually 30-year loans. The DSCR loans are 30-year loans. And we always sell those. So we're not going to keep a 30-year note. We short term. We like to turn the money. And the rates are lower, but I would not probably waste your time on these. But I'll show you how to price these to it. If we ever did a commercial loan, which we're probably not going to do a commercial loan, probably just not doing any because this market is making those to be tough. A commercial loan, a residential property with 5 units or more is considered commercial. A retail center like a strip mall kind of thing, or you go to Starbucks and Starbucks has a dry cleaner in the same parking lot over there, and El Pollo Loco over here, and you have this like those little centers right there. Those are retail centers. And so we'll do some of those. We'll do maybe an office building, but probably not going to do anything but maybe a mid-sized retail center. And we'll go up to $5 million loan. So what we want to know on a commercial deal, we want to know, is it owner user or non-owner retail? So owner user means they own it and they operate it. We prefer a non-owner rental because that basically they're renting their property to another business. The reason we like that is they're going to criticize the other business for being a good business because they want to make sure to get their rent. So it's kind of like an extra layer of protection for us. Because if they were the ones in their business, they could be a crappy business, but they're going to keep themselves out because it's them, right?
They don't have to raise their rent.
They don't have to raise their rent. Yeah, they don't have to do anything that's going to hurt them because it's them. But if it's somebody else, they're more likely to enforce these different criteria that's going to make sure it's profitable. Whereas they give themselves a break, they won't give a tenant a break. So we prefer them to rent it to somebody else. Owner users, we're just going to criticize them more because we know, you guys can suck and you're still going to try to keep yourself in there. So we want to know what's the gross rents from the property. We want to see if the property is in cash flow. Once again, the DSCR of the property. And then does the sponsor have other income that maybe would make sense? that even if it doesn't cash flow, maybe you get all this income from all these other things. And so you will be able to see that you can make a payment. Do you have cash invested in the property? Have you done a bunch of work to it that made it better? Do you have an old commercial appraisal? We can see those are the questions that I'm going to ask. So then these are all the questions. So let's say it's a rehab though. What I'm going to do is I'm just going to edit out what doesn't make sense. So it's a rehab, so I'm going to delete all this stuff on the other products because it's a rehab loan. Here's the range. I'm going to keep the rehab questions. I want to get rid of the DSCR on the commercial questions. I want to keep this because it says, hey, if we like the items, we're going to need an application, borrower's authorization, property docs, mortgage statement, HOI, that's homeowners insurance, and the budget if it's applicable. Get us this, get us an appraisal, then we'll get an appraisal bid ordered for your client to approve and pay. So appraisal bid is basically we contact our own AMCs, appraisal management company, that what they do is they find qualified appraisals anywhere we need them. And then we don't want the borrower or the broker to do that because they might have their buddy that says, hey, can you make sure that you get this value? We don't want someone to make sure they get a value. We want to know what the actual value is. And if it's low, we want to know that it's low. We want to kill the deal if it's killable. We want to fund a loan, of course, if it's a good deal. But if it's not, we certainly don't want to give a big loan on a value that's been like propped up. Because then the loan to value in real life is way higher because they got their buddy to get it in. So that's why we always control the valuation. And then these are all the general costs. Underwriting fee, 1995, Jcap fee, processing fee, $800. We usually have a doc fee of $500. We usually have an assignment fee of $690. This is just a back end thing when we change the ownership between our own entities. The state charges us assignment fees, and so we pass it on to the client. If we have to do an appraisal review, it's another $250. Title and escrow fees or whatever they end up being, that's just the cost of having title insurance and having an escrow. And then if it's a rehab loan, then we're going to do these other set of fees. Remember the holdback? There's like a fee to set up a holdback, and then every time they take a draw, there's also a small fee. So that's what these are. Now, remember owner-occupied versus consumer loan. So this owner-occupied versus consumer loans are very different because, when it's an owner-occupied home, means they live there as a primary resident. Then there's three types of loans that an owner-occupied loan can get. And this is in your hard money template, by the way. We'll go over that. There is, so owner-occupied, there is one is a consumer bridge. There's two biz purpose, and the third one is consumer purpose. So the consumer bridge is if you have a house that's your home, your primary residence, and you want to buy that other house to be your next primary residence, but you need to sell the current house to have the money for the down payment for the other one. And so sometimes people want to buy the other one before they sell. They don't want to make it a contingent offer because it's a real hot market, which it kind of is right now. And you say to this other seller, hey, I'll buy your house, but you have to wait. You need to sell this one. They want the money now. Yeah. So what we'll do is we'll say, hey, we'll do this bridge, consumer bridge, where we'll cross both properties. And I'll give you actually 100% purchase loan on this one. So I'll give you 100% of the loan to buy it. And then you sell the one you're moving out for them at your leisure. We'll give you an 11-month note. And then as soon as you sell it, then you're going to pay us off or pay us down so you can get into a conventional long term. So that's a consumer bridge. So this consumer bridge, there's no income qualifying. No income qual. Income qual. The business purpose, once again, so this is going to be a first or a second, but it's usually a second. I have an owner-occupied house. I have a first, it's usually a 30-year fixed, and I have a business. And I need the money to go to my business. As long as we can show that 75% or more of that new loan that we're going to give them is used for business purpose. And I'm going to say, okay, what kind of business do you have? You know, if they're a W-2 employee at the post office, like, you don't have your own business, bro. Yeah, sorry. But if they have their own side business, like maybe they're reporting a Schedule C on their tax returns, like, okay, you're showing, or maybe even better, they have an entity, LLC or something, and they're actually take the loan. Their entity is the one that's going to do the borrowing. It's not in a personal thing. I mean, they own the entity, they have full control of it, but it's an entity taking the loan, so you know it's obvious that it's a business loan. So we'll do that loan as a second position with the same limiting leverage as we talked about before, but it's on a primary residence. It's 75% of the monies or more of the money is being used for a business purpose. There's no income qualifying. So once again, no income. Now, if they can't prove it's a business and it's not a consumer bridge and they're using money for their own personal life, they're paying off personal credit cards, they want to renovate the house they're living in, they want to pay for their kids' college, they want to start, I don't know, whatever, they want to travel the world, they're in some kind of trouble. If we can't show that it's business, then it's consumer purpose. And if it's an owner-occupied resident consumer purpose loan, then we have to income qualify them just because those are just loan rules. There's this thing called the ability to repay, ATR. And then if that's the case, then that's where this thing comes in. Only consumer loans. Only consumer loans need income qualify. So non-owner loans, no income. Business purpose loans, no income. But right here, owner-occupied consumer loans need to income qualify. So these loans are given as a fully drawn, which means all the money goes out. And that means that it's just a line of credit. Don't ever tell anybody it's a line of credit. If people think of line of credit as like a laptop, they can use it as a credit card. Like they can use it and pay it back and use it and pay it back. We don't want people to do that. We want people to take the money and then pay it off and then we close it. But we give it to them as a line of credit just because that's a commercial loan. And the rate goes up after 1 year, and they have to qualify at 45% DTI, which is debt to income, which means that 45% of their income is used to pay for all of their expenses, minimum payments on credit, and all their housing expenses. So we have to add it up. If it's more than 45%, probably not, because we figure, oh well, 55% of your income used to do the rest of your life. You know, pay your utility bills, go to the movie, pay groceries. What's all the stuff that people do that aren't on credit? The only things on credit are like car payment, your credit card payments, any kind of bank loan that you get, those kind of things. But everything else that you do in life isn't on credit. So we're hoping that 55% of their income is enough for all that. 45% or less, then they qualify. That's what that means. And then this is a lot of detail, but also for the video, I'm just gonna have to watch the video. I don't do this every day. Ta-da! So we get you on camera to make sure that you're in for posterity's sake. That's Leo. Okay, so the last part here is more info on the fix and flip renovation loans. So this again is the construction holdback deal. And we were talking about in the scenario that 75% loan to cost, 65 ARV. We'll go more than that or less than that sometimes, but in this example, that's what we're going to use. So on a renovation construction holdbacks, we usually go up to 75% loan to cost. Cost is the purchase or the value of the property plus the budget and no greater than 65% of ARV or the after repair value. We do not forward fund construction budget. So that means that we're not going to give them cash. If there's cash to do your work, we're only going to say, hey, we have the cash, finish at least a line item, and then you'll get paid back. It's all in escrow, holdback, and then given to refund the borrower or sponsor after they paid the complete line item on the budget out of pocket. They pay it, and we pay it back. This is why we need to see 10 to 20% of the budget in liquid reserves after we fund, because they need working capital from their own funds to finish a line item to be refunded. And then also budgets hardly ever go as planned, and so we want them to have extra money. ARV, or after repair value, is the secondary limiter for the max loan and can decrease the loan if the ARV ends up being over that max percentage, as we talked about before. It came in lower than we thought. But a very low ARV percentage won't increase it over the max LTV limitation. Anything short of the max LTC and ARV, the borrower / sponsor would be out of pocket at the time of closing the holdback, so it's funded 100% to 100% of the budget. And then we went over an example earlier, but here's another example written down. Questions? Excellent. Is it because I'm such a fantastic explainer?
Yes, sir. The best.
Or are you just saying that?